As we already outlined, we are now starting with the first panel of today, the ESG panel. So I would like to ask my two guests and panelists here to come on the stage, and another colleague will be online joining from Frankfurt. So I do see Gunnar already.
Perhaps you can introduce him.
Yes, that's fine. So, yeah, first of all, let me just make a quick introduction to my ESG panel. The topic will be the latest trends in ESG. And I think we could discuss with this topic throughout the day, but we will keep it short and see that we get the most important topics done and handled within an hour. First of all, I would like to introduce you my panel. To my right, Fritz Mostböck, you have seen this morning already. He is obviously the head of Erste Group Research. Then he is the deputy chairman of EFFAS. Besides that, he is the president of the DVFA and also a member of the ESG Commission. Founder.
Thank you.
So, to my left, I have Dr. Rene Nicolodi. He is the head of equity and deputy of head of asset management and sustainability at Swisscanto. He is also a member of the EFFAS ESG Commission, and beside his day-to-day job, he is a very intensive lecturer at the Swiss Training Center for Investment Professionals, ATSEC, and also at the International Management Institute in Kiev. And having said that, I'll turn to the online audience and to Gunnar Friede. Gunnar is my dear colleague at DWS in Frankfurt, and Gunnar is a senior portfolio manager and head of ESG multi-asset and solutions at DWS in Frankfurt, and he is also a member of the EFFAS ESG Commission. And I'm really proud to have Rene and Gunnar with us today, because the two of them belong to the founding fathers of the CESGA, so to speak. And last night, while we have dinner, we were just reconciling that 10 years ago, so a decade ago, we were all sitting in Berlin, spending a weekend, obviously with Professor Alexander Bassen and some other guys at that time, to really get the CESGA program going. So it has a decade long of history. So I'm glad that we have you on board. And from the organizational point of view, I would like to start to give every one of you a 5 minutes introductory remarks concerning your individual impressions of the latest trends in ESG. And Fritz, if you would start at the very beginning.
Okay.
With your remarks.
Thanks very much. Yeah, what I'm seeing is that the whole ESG activities and area is not only focused on stock-listed companies, it's also focused on governments and their respective financing on the capital markets. So from my point of view, ESG is also, or has to be included in future, also, for example, from rating agencies. Rating agencies, by the way, play an important role, but most of them are still very much focused on financials, which is of course of importance. But now, for example, if you're looking to macro indicators or other debt levels, by the way, all the debt levels are higher for more or less all the states worldwide since the financial crisis. Then came the pandemic and now the war, so debt levels are furthermore increasing. Perhaps with the inflation now, the states can reduce somehow the debt levels, but overall I think also rating agencies have to be much more focused on ESG issues. Why? Because I think also a transparent communication is key in that respect, if you are especially focusing on the E, on the S, and also especially on the G. And countries who would have problems in this regard and show misconduct, I think will have definitely problems in raising funds, and therefore they will for sure have to pay risk premiums in future if they are not fulfilling also ESG criteria. On the other hand, and that's my last point, which I perhaps see as a latest development in the ESG area, with increasing gas and electricity prices, I think we saw recently huge pressure on utilities and electricity companies, for example, in Austria. And this is not only on stock-listed companies, it's also on not listed companies, because, of course, it's very much driven by households. It's very much driven by the public opinion and media, and therefore more and more also ESG criteria are also playing a role here. For example, in Austria, the people would like to know exactly what an electricity company is doing in terms of electricity price trading, because there are obviously some firms outside which have a huge portion in electricity trading and not so much in electricity production. Therefore, I think from not only from shareholders, from the public, from stakeholders, the pressure on utilities is really further increasing.
Okay, Fritz, thank you very much for these interesting points, and I think we'll elaborate on this after the first round. Gunnar, I would like to ask you to continue with your impressions, what's going on in ESG right now, and what are the next trends we are going to face with?
We cannot hear you.
So I'm unmuted.
Now it's fine.
Okay.
That's fine.
All right, perfect. So hello, Vienna. Thank you for having me on the panel. So what are the trends? And I think Fritz really put it nicely in his introductory statements to the conference. I mean, we have seen so many developments in light speeds in the last 5 years, and we have now more than 3,000 certified ESG analysts. And so it would be really tempting to say, with MiFID II, with SFDR 2 coming up for next year, CSRD upcoming, to ask about more and fancy data. But actually, I'm not doing this time because I think I'm concerned. And I'm concerned because we are a little bit losing track, I would say. So let me get one step back. We have now, according to Morningstar figures, roughly 50%, or actually more than 50% of the European fund universe that is in Article 8 and Article 9 funds. So that's a huge development over the last 3 years. And it's also projected to grow further, and I also hope that it will further grow. But what have we achieved with regard to the EU action plan? And this is where I have, some of my concerns here, because actually the idea was to reorient private capital into sustainable investments. That was the original idea. That's why it was designed like it is. And if I look on the statistics, what actually is going into renewable energy investments, that I see, yes, there was a nice uptick in 2020 and 2021, but 2022, in a situation where Europe is most urgently of need for renewable energies, as we know, we have a situation which is projected that the 2022 renewable investments and also maybe the next years will go down. And they are actually below 2010 or 2011 or 2012. And they are, let's say, more or less on the level like 2015 or 2016, where we talked about SDGs and the EU action plan for the first time. So I think this is really worrying me that we are, besides having on the paper and also with regulatory requirements, done so much. But actually from what is the real impact, we may take a step back and really think again of whether we have achieved these plans and how can we do better. And I think, so what would be for me the trends and necessities? I think renewable energy investments are as profitable as ever because you can see levelized cost of electricity. It has gone down massively, and it should be easy to really invest in this. But we need to speed up the renewable investments, and I think to really, focus on this, that we don't have 30 years of time, as we know, and that's why I think instead of talking about windfall profits for renewables, we should talk about reploughing all these additional, let's say, cash flow into renewable investments. Otherwise, we won't unsolve the situation right now. And I think the next part would be to really think about the foundational data that we are using in order to construct our Article 8 or Article 9 funds, being the principal adverse impact indicators, the social investments, and of course the EU taxonomy relevant assets. And I think we are still far away from having a golden source on this. And don't get me wrong, I think it's totally fair to assume that every rating agency and every investor can use their own data and their proprietary methods to determine what is ESG, but we need to have a clear and common understanding of what are the foundational data points that we need in order to construct the portfolios and also to exclude companies and include companies. And I think 3 years ago, we had the real hope that the EU is stepping in, providing these, let's say, really foundational data, and I think nothing has been achieved in that respect, which is really a pity. And I think this is really one of the weak spots, I would say, and this needs to be fixed and really urgently fixed. And then it needs also to be coordinated with also the new CSRD framework, where we still have the, let's say, deviation between what is asked from investors and what corporates need, and in which way corporates need to report. And this is, for me, totally surprising that this is not, let's say, harmonized in a way that we are talking about the same indicators and that we are talking about also the same timing, because the financial industry is reporting on data which is basically very much estimated. And this, I would say, need to be considered and fixed for the future as well. Thank you.
Great. Thank you very much, Gunnar. I think, especially with the quality of data, we will come back to this topic, I think, in the discussion afterwards. Rene, let us turn to you, what you consider to be of utmost importance in ESG going forward.
So thank you very much also for having me here. Let me try to make a maybe slightly provocative counterpoint here. So I have the opportunity, had the luck to look at the development of ESG since 2001, as I started my career as a sustainability analyst when there was no data around, basically. So looking at this time frame of roughly 20 years, well, not so many changes have actually happened, to be honest. ESG investing is rather simple. Let me explain you. If you know five instruments of ESG investing, you get the picture. We're talking about exclusions. We're talking about, secondly, about best-in-class approaches. We're talking about voting and engagement. We're talking about thematic investments, and we're talking about impact investing. These are the 5 instruments. If you know these 5, you basically have a good grip on what ESG investing means. Well, these 5 instruments were all around 20 years ago. 20 years ago, I was having discussions about exclusions as I have now. Now it's about weapons, maybe it's about energy, it's still about divesting or not, does it have an impact or not, it's the same discussion. Best in class is still around, pretty much unchanged, with better data, yes. It's more sophisticated, but basically the methodological approach is still the same. Thematic investments, we're still talking, and that makes sense, about the same structural trends, which are very, very long-term. It's about mobility, it's about urbanization, about demographic changes, it's about climate change and energy transition. Well, 20 years ago, same topics. Remember, on Convenient Truth, 2005, 2006, Al Gore, climate change in the footprint, still the same topic. Now, maybe we have biodiversity, which comes a little bit new, as a new boy in town, but very relevant. But other than that, we're still talking about the same thematic megatrends that we had 20 years ago. Voting and engagement, that has slightly changed for continental Europe because it was mostly, I would say, a thing coming from the US and the UK. That has definitely reached Europe. Why? For 2 reasons. One, because we have massive indexing growth in Europe, so a lot of passive investors. The only way passive investors can have an ESG role or an ESG discussion is by executing their stewardship by voting and engagement. No other means, because the fist will always stay behind the back. They cannot reallocate the capital, they're following a benchmark. So indexing has been a catalyst for, I would say, stewardship, voting and engagement. And at the same time, also as a catalyst for this topic, the changing fiduciary duty or fiduciary responsibility has changed over the past 10, 20 years. So 20 years ago, it was clear your focus is risk return, and that's it, and that's only it. Now, you are much more aware as a large asset manager, as investor, that basically beyond your fiduciary duty, you might have a responsibility as a big owner of companies. That also brings in the whole ESG topic. Lastly, impact. That was also around 20 years ago, recall of all the, let's say, microfinance funds, private equity funds, which were focused on certain sustainability topics. That has definitely changed. And it's also the area of I think, the biggest misunderstanding that we have. ESG per se was not, and I disagree maybe a little bit with the Mr. from EFFAS, was not, I think, not invented to have an impact. It was invented to have a better set of information, to make a better risk assessment, to make a better opportunity assessment of your investments. It was not per se invented to have an impact. So here, if we talk about impact, usually it's about alternative asset classes. It's about new capital allocated to companies, private equity. It's about new capital allocated in bond issues, green bonds, social bonds. It's about new capital allocated to, let's say, infrastructure projects, and so on. This is generating the most impact. So, looking at this time frame of 20 years, I'm a little bit, let's say, disappointed that we haven't changed more, to be honest. And at the same time, well, yes, there has been changes, and I point out 4 of them. Trend 1, the legalization of ESG, okay? So just think about how many legislators today are talking about ESG and are making the law all around ESG. Often at the same time learning about ESG, but making laws about ESG, okay? Secondly, the amount of internal compliance people that I have to deal with all around ESG issues is just exploding. So I have more discussions with compliance officers and legal officers about ESG topics than with my investment guys, which is impressive. And thirdly, the supervisory bodies, like the CSSF, the FINMA in Switzerland, and the BaFin, they are basically assessing and approving the ESG compliant products. So you have at different levels a legalization of ESG topics, which has come up over the past, I would say, 2, 3, 5 years, which has been astounding just to look at. That's the first trend. The second trend, which is a little bit linked to it, is the wish and need of the standardization of ESG. So there is a strong need, and I think it's a legitimate need to have a more standardized understanding of what ESG means and what it doesn't mean. Just think about the rating agencies, which have been named before. So there's an interesting scientific paper by the University of Zurich called Aggregate Confusion. One of you maybe know that paper. Aggregate Confusion analyzes different rating agencies and finds a correlation about different ESG rating agencies around 0.4. Okay, the correlation of credit agency ratings is roughly 0.9. For me, that's not surprising at all, like not at all. If you look a little bit deeper, these rating agencies are working with different sets of data points, with different sets of quality of these data points, apply different methodological approaches to generate the rating, different weightings, and obviously the results differ. So you can have, for the same company, a wide set of different ESG ratings, which is confusing for investors, is confusing for companies, and it's even more confusing for the legal bodies trying to make laws, assessing portfolios, making taxonomies, and so on. So obviously out of that, the need for standardization is really big, and therefore the work of an ISSB and other bodies is really important to at least establish the lowest common denominator on certain relevant things. Think of CO2 emissions, which is basically a quite basic data point. It's about CO2 emissions, scope 1, 2, and 3. In the reality, it's not so basic. I make one fast example. Scope 3 emissions have been a discussion point again for the past 20 years. I was looking at CO2 emissions 2006, 7, 8, talking about methodological approaches to discover scope 3 emissions, which are the most important part because they make roughly 80% of the emissions of the total is scope 3. It's not scope 1 and 2. Now, usually you don't have good scope 3 emissions on the market. Now there are big, large data providers which come up in the past few months with scope 3 emission data. Everybody's happy. Well, we have scope 3 emissions. If you look at the methodological approaches, they're not corrected by double countings. This is methodological, I'm not saying crap, but it is, because basically you count the same emissions a multitude of times without correcting it. If you base your Paris-aligned benchmarks, your strategies on scope 3 emissions without correcting for double accountings, you run into serious problems. You're not able to make a credible, consistent net zero strategy, for instance. So these are problems that need to be addressed from a standardization point of view, from a regulatory point of view, in order to help investors and companies to come up with, let's say, consistent, valuable strategies. Third trend, also linked to this, digitalization of ESG data. Think a large asset manager that wants to integrate ESG data across a large number of products. Swisscanto, ZKB Asset Management, we manage 220 billion in assets under management, roughly 200 plus fund strategies, and we have the aim to integrate ESG data across all the strategies. That implies you cannot do this if you don't have a sophisticated IT platform which is able to manage large data, which applies machine learning and AI algorithms to analyze the data on the analysis part, which is then able to make good investment decisions in the production part. And obviously, the most important last step is to be able to produce on an automated basis reports for the clients, which need to be in line with what you analyze and need to be in line with what you make in your portfolio. Okay, if you say I have a reduction path, you need to have the data, the analysis, you need to be able to construct portfolios and need to be able to show what you do in your portfolios in a reporting. This is basically digitalization. Not anymore possible to do this in a manual way with the amount of data you need to analyze and let's say, produce in such a value chain. Last point, education. EFFAS has been, I think, in the forefront of the ESG education, as Frank has mentioned, over 10 years ago, trying to push out a standardized and valuable program. Now you have ESG courses all over, which is a good point with all these legal guys and investment guys and analysts and portfolio managers need to be educated on the value of ESG data in a realistic way, not being overexcited. ESG data per se is not an alpha generator. You will not generate a better performance just by taking ESG data in. It needs to be integrated in investment processes. It needs to be analyzed in a certain way in order to enable better performance. And that's the role, I think, of education, and that's the fourth large trend that I see.
Great. Thanks a lot for these very interesting points. I think we will also come back to some of them in the discussion. First of all, I would turn it now, after you have heard these three inputs from experts on ESG for future developments. I would like to open the floor, first of all, here in Vienna. Are there questions, answers, remarks on the things you have heard from the audience here? Just wait, because you'll get a microphone, because otherwise the people online couldn't hear that. Microphone is coming. Please.
Thank you. One question on the last comment you made. Would it make sense to integrate ESG in the performance attribution system which is used? Not only include like currency, timing, location, and also ESG, or should it not be included?
No, absolutely. It would make sense. It makes sense. And you have one or two problems with it. One is if you make a performance attribution based on, let's say, the so-called market betas, the risk factors, you need to be sure that it is a risk factor. Okay, so you have the classical, let's say, Carhartt factors, which you have the market, you have the momentum, the value growth, the size. These are the classical ones based on decade-long statistical data in order to, let's say, identify that it is a market risk. That allows you then to make a performance attribution and distinguish between idiosyncratic risk and market and factor risk. Okay? Now, you don't have the breadth, I think, the necessary breadth and the necessary length of data in order to establish inasmuch the one or the other ESG factor or aggregated ESG factor has the quality to become a, let's say, systematic factor, which is the lead in order to be able to make a good performance attribution. We did studies back 2008-09 to enhance the Carhartt model with an ESG factor. We did that with a university. The results were positive, but still with a certain, let's say, insecurity because of the length, the missing length and quality of data. But that will change over time.
Okay, thank you.
Thank you very much. Any further questions, please?
Where do you see the role of equity investment in order to accelerate ESG topics?
Whoever wants to answer, Gunnar, Fritz, Rene.
Perhaps Gunnar.
Gunnar, perhaps as also an investor's point of view.
Yeah, I mean, the current situation is that we probably have to focus on the bond side because the, let's say, transmission mechanism via green bonds is working from a listed perspective, let's say, faster and more direct, I would say. On the other side, as we know, it's about total, of course, capital allocation, and not only for fixed income capital, but also for equity. And therefore, I think in the long run, the equity markets are really, really important. It doesn't need to be underestimated. What I currently see as a worry, and this really worries me, is that the ESMA and also the CSSF probably not thinks in that direction, that they have a tendency, at least from my gut feeling, to really more focus on the green bond side and on the debt side, because on the equity side, it's not so easy to, let's say, talk about the direct link of, for instance, sustainable investment shares and so on and so forth. But I think you are totally right. The equity side is, from a total risk perspective, from an equity perspective, really, really important. And we shouldn't underestimate that. For me, it's really both sides. The fixed income side, the equity side, and of course the direct link via the alternatives channels are really the key ones.
Perhaps I just add one sentence on that, because if you are looking just to the stock-listed industry worldwide, to all that large caps, we made a calculation years ago that they represent more or less also via various channels the largest portion of the GDP production worldwide. So that means they represent roughly 80% of the total GDP, which is more or less generated by the stock-listed industry. And therefore, it is important that ESG is a topic on the equity side.
Now, from my perspective, now I'm hardcore equity guy, so I'm totally biased here. At the same time, well, it's clear. If you own equity, you are owner. Okay, you're an owner. So we are a Swiss asset managers. We manage roughly on the active and index side, we manage 16 billion in assets in Swiss companies. So for every Swiss company, we are in the top 5, top 10 owners of this company. That means we have direct access to CEOs and boards. That means we are heard. That means we can influence. And we've done that with, let's make an example. We have a strategy which we implement for all our active approaches on the equity, fixed income, and balanced side, which it's a quantitative climate reduction path, which in every year we reduce the carbon intensity of your portfolios. Quantitatively, mandatory for every portfolio, PM needs to execute it, unless he won't get a bonus, okay? As simple as that. But that means you have two instruments to act on the portfolio side. One, you reallocate your capital, okay? Sometimes you don't want to do that because you think, well, the companies are actually good. So the second element is engagement, okay? So we talk very actively to large companies, let's say in the cement area, to have SBTI aligned carbon strategies. We follow up on that. We control the data. We want to see if the path that the company makes is aligned with the things we want to see in our portfolio. And that doesn't generate necessarily a short-term right now impact, but over time, together with other investors, you move the market in a certain direction. If I go back to my initial times, 2002, when there was no reporting, GRI was just starting, and no ESG data, we wrote to companies, we sent out questionnaires to companies all around the world asking for ESG data all the time, permanently, together with other, let's say, early stage investors. That definitely triggered the growth of the GRI, the awareness on the corporate side that potentially this set of investors is important and we need to scale up our efforts on the ESG data providing side. So yes, as an equity investor, you can have an impact. At the same time, if you want to have a direct impact on sustainability, well, you need to go into alternatives. You need to provide new capital to young firms. And if you look at the trends, more companies today are moving into private, from public to private, and not from private to public. That's a very interesting trend over the past 10, 15 years, if I look at US statistics.
Great. Please, just wait for the microphone.
Thank you very much for your remarks on trends. It's really interesting to hear that not only ESG is applying to businesses or to investment targets, but as well as to governments and rating agencies are paying more and more attention to this. Thank you, Fritz, for this. Also, Rene, I'm not absolutely agree with you when you told that you have a contradiction with the first speaker when talking about impact or quality of data. From my point of view, it's another vision on what is ESG standards should be, because it's really important now to standardize this information, not to have a biased data. Thank you very much, the panel.
Thank
You know, I agree with you on the need of standardization. At the same time, you will not standardize the way investors are using the data. Just make you an example. If I look at any listed company and I look at the analyst recommendations of any listed company, and we are talking about accounted financial numbers reported every 3 months in the same way for the past many, many decades. Well, the results of the analyst recommendations are usually 10–20% buy the stock, 30% hold the stock, and a few, let's say, divergent analysts say sell the stock. So even if the numbers are the same, so why should we aim for ratings that suggest that there's only one view on a company with regard to their ESG profile? We should aim for a standardized set of information.
Yep.
What I make with the information should remain a value proposition and should generate friction among market participants, because that's the role. Generate information exchange, reduce information asymmetries, give pricing signals. That's the role of capital markets, and that should also be the role for ESG data.
Yeah, that's a very important topic from my point of view. Why? Because, of course, we should reach somehow a level of standards which are harmonized. But I think if there is only one standard outside at the end, it's a monopoly. It's also not good. And therefore, what Rene said before is important, because, of course, different asset managers are running qualitative models, are running quantitative models, but that's the market. That's the variety of different opinions and different evaluations, and that exactly makes a market. Just having one standard at the end is for sure also not a common goal which is good for any functioning capital market, I would say.
I as an investor, I want to have standardized, third-party accounted, proven data points from companies or from whoever. That's what I want to have. What I do with the data, in my office, I will never use third-party ratings, ever. I want to aggregate the data that I think is good in a way that I think is feasible and helps my investment decision-making process. That's my job.
Perhaps as a summary of what we have heard, the three of you outlined how can we improve the quality of data. Rene said you were coming over 2 decades from A to B, but it's not good enough. Gunnar also outlined that. So my question is, when we talk about the rating agencies and their importance for market participants, one way or the other, and the data, and this afternoon we will hear from the Austrian Post the idea from the horse's mouth, because the corporates have to deliver the data one way or the other, disregarding whether they go directly to the investors or analysts or via the data providers like the rating agencies. what would be your concrete recommendation? How can we improve from here? Yeah, you said we spend too much time with regulation. Unfortunately, I think there will be no good news from that side. The next 3 years, we will spend also a lot of time with regulation. But what can we do concrete in order to give you better data? And Rene, you outlined the scope 3 things where you don't even have the double counting problems. So what are we going to do in order to improve?
When it comes to rating, that's a special topic from my point of view, because rating agencies play an important role, but on the other hand, I think they learned also a lot during the financial crisis, as you know, because a lot of rating agencies also rated subprime instruments with AAA. Anyway, therefore, I think it is important also from my point of view, because as you know, all these large rating agencies have these rating scales, and it's more or less more than 20 different ratings where a rating agency can focus on. But on the other hand, they can hide quite well with the different ratings. When you are looking just to what we are doing, or what investment banks are doing, it's more or less simple. It's buy, hold, sell, or it is buy, accumulate, hold, reduce and sell. So it's a pretty simple rating scale. And if you're looking to the rating scales from rating agencies and also the evaluation, the traditional evaluation, not taking ESG into account, is more or less also a black box, because you cannot get the information how they are coming to the specific opinion, and everybody is doing it different, and therefore I think perhaps a little bit more transparency in that regard would be also great.
What do I need, or what can we do? Radical simplification. So take out as much as possible the complexity out of processes and data and ratings and everything. So therefore, I expect from the regulatory bodies, the work of the ISSB, to go simple, achieve maybe less complexity, but where they act, let's say, example, CO2 data, be very precise and establish at least a lowest common denominator on certain things and do these things well, then try to achieve everything, but create a huge complexity that nobody understands and nobody is able to handle right now.
That's the point.
That's my wish, point one. Point two, rating agencies. Let me make you an example on the credit rating agencies. So if you are a manager and you manage a corporate bond portfolio for institutionals, and there is a large client who is seeking a new asset manager for a corporate bond portfolio, you need to be able to show to the consultant or the client that you have your own rating research or credit research capabilities in-house. You cannot go there and say, well, I rely on Fitch, Moody's and S&P and that's enough. Well, that's just an information you have, but you need to do your homework. Mm-hmm. That's the traditional fixed income world. So this is not different on the ESG side. Well, yes, you can look at what the rating agencies are doing, but you need to do your own homework in understanding what kind of data leads to what kind of investment decision. That's the basic work you need to do, and in order to be able to do that, you need to have talent, skills, knowledge, and experience. So you need to invest if you haven't done that in the past. That's quite, I think, a simple logic for success, because you won't be able to explain to any client a third-party ESG rating with 750 sub-indicators, which is just not you don't understand it, and it changes all the time. Mm.
Gunnar, anything from your point to add on that?
Yeah, actually, I think we are not so far away from what Rene also said and Fritz. I think on average, the ESG ratings are, let's say, higher correlated than we may think on average, in particular for the leaders and for the laggards. So I think if we're stripping out one of the typical ESG rating providers, on average, the rest of the ESG rating providers is way higher correlated, around 0.7. Just to, let's say, bear this in mind and compare this to the 0.9 on the fixed income world, I think considering the multidimensionality of ESG and considering the thousands of sub-indicators going into this, this is tremendous with regard to what is, let's say, the common denominator on the highest level. But I'm not so much on this side. I'm really more, let's say, concerned on the foundation of this. And I totally agree here with what has been said before. And what I made also in the intro statements, we need to focus on these real important foundational data points. Carbon is one thing, and I couldn't agree more. Scope 3 emissions are 80% estimated, and alone the MSCI all-country world generates the double of the Scope 3 emission that is, let's say, emitted globally. Just to bear this in mind, there's so much double counting of, let's say, in the autos, in the chemical side, on the airlines, and so on and so forth. So huge issue, but of course we need to rely on this, and we are asked by the regulator to rely on this. And this is something where I really see a huge mismatch, where we need to focus on carbon aspects and all the other related PI aspects like gender pay gap, biodiversity, and also with regard to the other environmental indicators, where we really need to have a foundational basis that we can rely on, and where everyone can make their projections based on this. And this is where I see ESG rating agencies should be helpful and need to be helpful to combine this, condense this, make some estimates where we have some gaps, but in the end make the projections. And we, of course, as every investor, we need to make our own mind. What is our own definition? What are the data points that we need to focus at and compare this against? But I think if we have the foundational set of data, then we have achieved a lot. But unfortunately, the CDP has been founded 20 years ago, and we still only have reported numbers for Scope 1 and 2 emissions that are less than 50% of all the corporates. So the rest is estimated in particular for the rest, and this is just one example of where we are. That's why I think it needs to be stressed. Let's focus on the groundwork, on the layer, where we can build the rest of our ESG world on it.
Great, thank you. We have some questions from the audience here in Vienna. Please.
Thank you. One question. I mean, I fully share your views with regard to active management, but one question would be, now we learned that roughly 50% of asset under management are ESG managed within Article 8, Article 9. Now, how much of that would actually be active managed and how much is passive managed? And I think this is a bit of my concern. Of course, it's your decision as an active portfolio manager to give trust to the rating agencies and actively do your own decisions. But when you have a passive product, I think you're tracking some ratings or whatever. And my fear is that this passive share is relatively high and is gaining importance, and that's why it's moving the market.
Well, as an active manager, but who has also in-house a very large indexing business, I can tell you that the ESG index business will grow, and will grow fast. Okay. Now, as somebody also very convinced about sustainability, ESG data, and active management, I think for the moment and for the years to come, a large part of good ESG investing will remain qualitative. And by being qualitative, it requires fundamental analysis. Okay? Make a differentiation between how a company acts and what it produces. The ESG data part for the most part, focuses on the how. So how a company produces the services and products. Energy efficiency, water, and blah, 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 which is important. But usually, you don't have good information on the product side, the what, the products. Okay, that's usually focused by qualitative analysis. You need to understand the product, you need to understand the technology, you need to understand the market, the competitors, the peers, and everything. There's no good ESG data. So that's also my concern when we think about SDG investing with the 17 nice goals, because here we usually focus on the what kind of products and solutions lead to an impact on the SDG side. This is hugely qualitative. I close the circle. If it's qualitative, if it's fundamental, it's not indexed. As simple as that.
Yeah, if I may add, I mean, I think there is nothing wrong about the active versus passive discussion. Of course, we would rely on just one single provider in that regard. You are right. But on the other hand, I think if we have a more common denominator, then I think it's also acceptable to have such strategies. And of course, you're right. The passive side is around 50% in all these assets. In Europe, slightly less. In US, slightly more. But of course, it's a huge, let's say, part in that regard. But the main question is, when it helps to really channel the investments into renewable investments, into the right social and environmental projects, I don't have any problems with that. And this needs to be assured. And this is also been taken up by the regulator with regard to auditing, for instance, the ESG rating agencies, and of course the index providers. So I think on this side, I don't see any huge issue. We can discuss about, let's say, engagement and other related topics from the passive side, which may also might be interesting. But from the channeling of investments, I think every euro helps to solve our long-term problems.
Thank you, Gunnar. We do have one question from online before I turn to you. Why is the industry investors not coming together to build a sensible data set? What would it take to come together as industry participants and not waiting for regulators? So how to organize ourselves, so to speak, instead of waiting for regulator input. Is it possible at all?
I would be a little bit skeptical.
Perhaps, Gunnar.
I would be a little bit skeptical on this. I think that is not typically our, let's say, business and our expertise. And I think we need to rely on intermediaries and also the companies reporting the data. So I see our role as investors more in the area that we are actively asking the companies to provide that data and also then channel it back. And this is, I think, is what we are doing also with regard to our engagement strategy, that we are asking companies about reporting on the EU taxonomy, reporting on sustainable investments, reporting on certain biodiversity issues, respecting the SBTI and so on and so forth. This is where I see our main role in that.
I mean, the industry is coming together to a certain point because the industry is represented by the likes of EFFAS, EFRAG, is taking part in the discussions with the ISSB. So investors are actually focusing on that, but to have the belief and the vision that the investors themselves come together, well, there the competition is simply too high. If I am able to extract a sensible data set for myself, that's gold. My data is the new gold. I won't share that with anybody else. I will keep it for myself and try to make the best of it.
On the other hand, perhaps just add one sentence. I think when an industry is setting standards, perhaps it's good if the asset management, and I'm not a representative of the asset management industry, but if the asset management industry is for example, doing its own code of conduct, it's okay. But if they are setting their own ESG standards, I think it's also not good from a perhaps compliance point of view.
Yeah. And perhaps just as a summary to what Jean-Philippe said this morning at the very introduction with Patrick, we as EFFAS participated very actively in the current consultation. So we raised our hand and we said, look, the EFRAG consultation was too tedious because it was too granular and ISSB was not granular enough. So we just encouraged these sort of role setters by taking their heads together in order to come to a common conclusion. That's what we said. And I think this is our goal also as a European association. Detect what's going wrong and go for the standard setter and push them in the right direction in order to get what is necessary from an investor, from an analyst, and also from the corporate point of view. But you had one question, please.
Thank you so much. Actually, I have two questions, if I may. The first one is talking about standard. We know the new ESG fund reporting standard, it's called European ESG templates. It's coming out, and we're reading the news that a large part of the Article 9 funds will threaten to be downgraded. I want to know your opinion or your thoughts on it. And the second question is talking about rating agencies. Do you see new rating agencies emerging or coming, gaining importance with ESG focus? Thank you.
I just can answer the second question. Of course, the whole rating agency market is mainly dominated by the three large rating agencies. You name it. There is a larger rating agency in Europe now coming up, but I never heard something really in concrete terms what they are exactly doing. There is, from my point of view, a Chinese rating agency, and there is also another rating agency, but I think they are based in Canada mainly. It's the fourth largest rating agency called DBRS. So it's more or less focused on US, North America with 4 rating agencies that they are dominating. It's a Chinese rating agency and a European one. And there are some specific ESG rating agencies, as you know, but they are more or less also operating in a different market somehow.
Yeah, so I agree on the rating agency side. For your first question, it's very simple. It's a mess. It's a complete, utter mess. So we are in the middle of looking at Article 9 in the new world. Basically, the law is not clear, is not well formulated, is open for dozens of misunderstandings. The consultants that you take on board and you try to ask them, well, how should I interpret that and that point, are not able to give you a good guidance on that. And finally, when you talk to the supervisory bodies, which should accept or prove your templates, they simply don't know how to handle it because they don't understand the law very well. They have the same questions about the laws. They don't know the ESG part of it, and they would need to take these parts together in order to give a clear signal. And that's a recipe for potential huge market risks and a bad outcome for the ESG topic, and that would be a fallback in greater terms. And I'm not sure how we could avoid that, to be honest, at the moment.
Gunnar, anything to add from your side?
Yeah, I'm also concerned looking on the data from the EET, where you see that 80% of the funds of the Article 9 funds don't report any sustainable investment shares. That's certainly, let's say, an issue. I think it's also, on the other hand, an issue that Article 9 was relatively broadly defined in the first stage, and then later on in the course of this year, the regulator then have a let's say, new definition of what he thinks are, let's say, achievable or necessary sustainable investment minimum shares. And I think there needs to be find a balance because otherwise, as talked beforehand, the regulator will only channel money in the end into green bonds and will leave out the rest of the investments on the equity side and maybe also on the multi-asset side, because I think the levels that we are hearing of what is, let's say, the regulator's target are maybe relatively high. So we'll see how this turns out. But I think it's good that we have the EET where we see the minimum disclosure that every fund is targeting, and then also see, on the other hand, what is the actual sustainable investment share. That's certainly a good thing, but the rest will be written in the next couple of months. It will be quite interesting, that's for sure. On the other hand, once again, it's important that we channel the money into the right equity and fixed income proportion, and we shouldn't really forget about the multitude of really assets that need to go into the right direction and not kill, let's say, some asset classes because of some regulatory demands that cannot be fulfilled in certain asset classes. I stop here.
Great. Gunnar, thanks a lot. I would consider this to be a very good closing remark. There's a saying, time is flying when you're enjoying yourself. And I think this hour passed by very quickly. So first of all, I want to thank the active audience here, also the audience online. And in particular, I would like to thank my panel for a very transparent and very intense discussion. So please give them a hand.